What is a good credit score? Consumer credit scores are three-digit numbers used by lenders to help determine a consumer's creditworthiness. They range from 300 to 850 points. There are two main consumer credit scoring models, FICO score and Vantage score. What is considered a good credit score depends on which model you're using. FICO score was introduced by the Fair Isaac Corporation in 1989 and is used by 90% of the top lenders. Any score falling within the 670 to 739 range of this model is considered good, one of the 5 ratings used by FICO. A credit score falling below 670 falls into one of 2 categories, fair or poor. A score above 739 falls into either the very good or exceptional category. Vantage score was introduced in 2006 as a joint venture of the 3 major credit bureaus, Experian, Equifax, and TransUnion, but is managed by Vantage Score Solutions. With Vantage Score, any score falling within the 661 to 780 range qualifies as good. A score below 661 falls into one of 3 categories, fair, poor, or very poor. Any score above 780 is considered excellent. 5 reasons credit scores and credit score ranges matter. 1. Your credit score may determine whether you are approved or declined for credit. Many lenders have firm credit score cutoffs. 2. Your credit score may determine the type of credit you're offered. Higher credit scores typically open doors for more advantageous types of credit. 3. Your credit score may determine how much credit you are offered. A higher score may qualify you for a larger loan or credit line. 4. Your credit score may determine the interest rate and terms you are offered. A higher score could get you a lower interest rate and more favorable terms, such as lower or no fees. 5. Your credit could affect your employment, rent, or car insurance. Depending on where you live, employers may check your credit report, landlords may check your credit score, and your insurance provider may base your premium on your credit-based insurance score. How to get a good credit score. Build a positive payment history by paying your bills on time, every time. This is the most important factor in calculating credit scores. Regularly check your credit reports for inaccuracies and dispute any errors. Review them at least once a year. Maintain a healthy credit utilization ratio, typically 30% or lower. Paying down credit card balances could help lower this ratio. Apply for new credit sparingly. Every time you apply for credit, a hard inquiry is typically conducted, which could lower your credit score by as much as 10 points. Avoid closing older credit accounts. Even if you're not using them, older accounts could be contributing toward a higher credit score. Increase credit card limits, but don't use the available credit. This can help lower your credit utilization ratio, which can raise your credit score. Add to your credit mix. Credit diversity plays a role in calculating a credit score, so consider adding a revolving or installment credit account to your mix. There's plenty of upside to having a good credit score and no real downside. By following these tips, you should be able to push your credit score into the good category, or even higher.